What's going on, guys? Welcome back to the channel. My name is Anfernee McLemore, and in this video I want to take the time to give you guys a step-by-step in-depth tutorial to everything you need to know about getting started in the stock market. You see, the stock market is and has always been a place where people go to in order to invest their money and make a little bit of money on top of that. However, talking to a few of my peers and even friends at times, there seems to be a lot that is not understood about exactly how the stock market works, and if you are a beginner, exactly how you can get started with as little as $5. So in this video, as I said, I plan to break down exactly how you can get started in the stock market as a complete beginner without having any investing experience prior. I'll go through how to create a personal balance sheet for yourself, what mindset and expectations you should have when you're getting started investing. I'll then go through 4 investing strategies that the majority of people use, and at the end I'll go through my personal investing strategy and give you guys a live look into my personal investment portfolio to show you guys exactly how I'll put the things that I talk about in this video into action. So take your pen and paper out, buckle up, get ready to take some notes because this video should be pretty fun. So first and foremost, to lay some things out on the table, when you want to get started investing in the stock market, you have to first understand where you are in your financial life right now, because it doesn't make much sense to start investing in the stock market if you are drowning in debt, have high interest rate loans that you can't pay back, all this yada yada yada. You want to make sure that you are in a secure place financially before you start trying to get rich in the stock market. So the best way that I have found to do this for myself is to create a personal balance sheet for yourself. Now, what a balance sheet is basically a piece of paper that lists all of your assets or things that you own of value and all of your liabilities or money that you owe out to other people. So in order to create a personal balance sheet, what you want to do is go through all of your checking accounts, write down exactly how much money you have, how much money you have saved, how much money you have in your checking account, and also the value of any high ticket things that you own, like cars or houses or anything like that. Understand exactly what you have. Now, once you do this, you can then move on to the other side of the balance sheet and list all of your liabilities. What car notes do you have? What high interest rate personal loans do you have? What medical bills do you have? And if you are at a point where your liabilities are greater than your assets, or you have some high interest rate credit card debt that's anything over 7 to 10%, then what I would recommend you do before you start investing in the stock market is get this fire under control. Because realistically, by putting your money towards this debt first, you will be making more money in this way guaranteed than by investing in the stock market. Now, I'll get into investment expectations shortly, but the key here is to make sure you have a secure foundation to stand on. You don't want to be building your investment future on something that can collapse to the ground if one loan officer calls their loan due. So what I recommend for a strong personal balance sheet is a balance sheet that at least has assets that's equal to your liabilities minus a mortgage loan or any auto loans. And also, if you have an auto loan, if that auto loan has an interest rate of over 7%, then you should prioritize paying back that loan first before you get started in investing. Now, once you have your assets in order, you have your liabilities in order, then you can move on to the next step of investing in the stock market, which is actually by starting to educate yourself and changing your mindset towards investing. And the best way and the most powerful way that I have found to do this is by reading books. Now, there's a lot of books that I can recommend about investing, but there are about 2 or 3 particular books that I would really recommend every single beginner investor read, because these books can completely change your mindset around investing and provide you with a complete new outlook about what you do with your personal money, even if you aren't investing in the stock market. Now, the first of these books is probably the most popular, and that is called Rich Dad Poor Dad by Robert Kiyosaki. Now, the first time I read Rich Dad Poor Dad by Robert Kiyosaki, it was like a monumental wave storm in my life, because it completely washed away all the preconceived notions that I had around money, and it taught me exactly how the rich treat their money in comparison to the middle class and the poor. And basically, to sum up the entire book, it teaches you that quote unquote poor people buy stuff or things that they don't need, the middle class accumulate liabilities in the form of car loans, auto loans, and mortgages, and the rich buy assets or they accumulate things that make them money over time. Now, understanding that simple concept at a young age will set you up for the rest of your life in terms of financial preparedness. Understanding that you need to accumulate assets and not stuff or things or liabilities will allow you to go a lot farther in your investing journey than if you just went about it willy-nilly. Now, the second of the 2 books that I recommend is called Financial Freedom by Grant Sabatier. Now, this book is more about financial planning and a little bit more about investing, and it gets a little bit into the technical side of investing, where you talk about using tax-deductible accounts, Roth IRAs, different things like this in order for you to understand exactly how much money you would need in order to be financially free. Now, although I feel like this book is more associated with beginners, I definitely think it uses some jargon that the everyday person may not be able to understand. So I recommend reading Rich Dad Poor Dad by Robert Kiyosaki first and then moving on to Financial Freedom later. However, after reading these 2 books, the goal is to have a simple, fundamental understanding about what you plan to do in the stock market. At this point, you still probably won't know what to buy or how to get started, but at least you'll have a broad highway of what direction that you plan to be headed in. You will know that you would need to accumulate accumulate assets, and you would know around how much money you would need in order to live the life that you plan to live once you reach your retirement age, which may be at 25, 35, 45, any age that you choose. And once you have officially changed your mindset and removed the stigma around money and eliminated most of your temptation to waste money on things that you don't need, you can then move on to this third step of getting started investing in the stock market. And that step is understanding the expectations of the stock market. Now, if you look at most millionaires or even billionaires in the world today, if you look at where their wealth was created and where their wealth sits at now, 90% of the time their wealth sits somewhat in the stock market. Warren Buffett, Bill Gates, Elon Musk, I would say 90 to 95% of their wealth is either in their respective companies or in an investment portfolio that consists of mainly companies in the stock market. Now, because of this, many people see the stock market as a way to get rich quick. They think that, oh, if I just get started investing in the stock market, I'll be a millionaire, or I can turn my $100 into $10,000 because I see these ads on Facebook and YouTube preaching how easy it is to do it. But you must understand that while yes, people do become millionaires in the stock market, and yes, people do turn $200 into $1 million by investing in Dogecoin, the average person won't be able to do that, and the average person will lose a lot of money while trying to do that. These cases where people go from zero to trillionaire overnight are outliers in the grand scheme of things. If you're looking at an average return to the stock market, and the way we can do this is by looking at the S&P 500, we can see that the stock market returns on average about 7 to 8% year over year after accounting for inflation. This means that if you invest $1 into the stock market, at the end of any given year, you can expect to earn about 8 cents per dollar on your investments. Now, some years this will be greater than 8 cents, and some years you may even lose money, but as this trend averages out, it's around 8 cents per year. Now, this is important to keep in mind because while 8 cents per year may seem like a little bit of money, the beauty in a stock market is all about the long-term objective, meaning that while yes, in the first year, 8 cents per dollar may seem like a little bit of money, while in the second year, you won't just be earning 8 cents, you will be earning 8 cents on your $1.08. So each year, the money that you earn will be earning you more money if you decide to leave it in the market. And once you do this over a number of years, your money will start to compound. What the money you actually make makes more money for you, and your principal is small in comparison to what you're actually earning. Compound interest is like the eighth wonder of the world, and it's the reason why you can invest $500 a month in a Roth IRA and become a millionaire in 30 years just from investing in simple, safe investments. You don't have to chase the next AMC or GameStop or Tesla in order to be a millionaire. Consistency and discipline over a long period of time wins in the stock market. And by being consistent, you will most likely beat out all the people who are trying to chase those big gains anyway. So those first three steps were more theoretical or fundamental steps of investing in the stock market. So now let's talk about some strategies or some actually concrete things that you can do today in order to open your brokerage account and get started. So basically, in my eyes, there are about 4 ways that you can take when you're getting started investing in the stock market. And the way I want to talk about these strategies in this video is going to be from most basic beginner level strategies that are likely to earn you more money over time to the more speculative and risky strategies at number 3 and number 4. And depending on your own personal risk tolerance, you'll be able to take any one of these strategies and develop into an investment profile. And the first of these strategies, and the one that I use myself personally, is actually called index fund investing. So if you are a beginner, index fund investing basically involves buying index funds or funds that take a whole bunch of companies and combine them into one stock that you can buy, and you just continuously buy index funds over time no matter what the price is. In this method, you are basically trying to cast as wide of a net as possible so that you can benefit from all of the goods of the economy. Some of the most popular index funds are the S&P 500 index fund or even a total market United States index fund. And the reason why these funds are so popular is that they have consistently been able to make money over a long period of time. And also they are much more predictable and much more sustainable than if you're trying to chase the next Tesla, because it is not likely that you will find a stock that goes up 1,000% each year, every single year. So by index fund investing, depending on your own personal strategy, you can expect to earn anywhere from 4 to 8% a year, and compounding over time that can lead to a lot of money in 10 years. At the end of this video, as I promised, I'm going to take you guys into my own personal portfolio and show you guys exactly what I own in my own index fund investing strategy. So stay tuned for that. The next investing strategy that you can pursue is called a fundamental analysis strategy. Basically, this strategy is what the great Warren Buffett uses, or what any Wall Street investor tries to use, and that's taking the concept of buying companies that seem to be undervalued and holding them for a long period of time. Now, this is not necessarily the buy low, sell high strategy, because with fundamental investing, once you find a company that you feel like is undervalued, you want to buy it and then hold it because you got it at a good price. You never really plan on selling in this price because hopefully that company that you bought will pay you dividends and actually give you a paycheck just for owning their stock. So with fundamental analysis investing, you do a lot more work on your end. You'll be wanting to read company financial statements. You'll want to be understanding what the management team projects for the company going forward. You want to be a lot more involved with what the actual company is doing to make money and how they plan to keep doing that that moving forward. You see, with index fund investing, as I just talked about, you don't have to do any of that. Basically, what you're doing is taking a tiny sliver of the overall US economy and putting it in your pocket and allowing it to grow without really caring about it. With fundamental analysis investing, although it may not be the hardest form of investing, you still have to put in a lot more work on the front end. Even with me being a finance major, I still have a hard time understanding what PE statements, what other financial statement items mean, and also at the end of the day, you have to be a little bit lucky in order to pick the right stock, because there's no guarantee that even though that you do a great job at fundamentally analyzing the company, you still may see returns less than what you would do if you had invested in an index fund. But that leads me to the third investment strategy that you can pursue, and now we're getting a little bit more into the risky side of investing, and I would say this is more gambling than actually investing. And this third form is called technical analysis. So basically what technical analysis is that you're going to be trading a stock based on momentum. If a stock like GameStop, AMC, or any sort of hype stock seems like it could run up in a short period of time, what you want to be doing with technical analysis is trading it on a daily or a weekly basis and buying it when you feel like it is low and selling it when you feel like it is high. Basically, this form of investing is not actually worried about what the company does to make money, but more worried about what the stock does when something does happen. So if a company has a bad earnings report, you can expect their price to drop in a short period of time before leveling out to a comfortable level with investors. And I have tried day trading in the past because it seems to be a form of quick money. People are attracted to it because you can seemingly get rich quick with day trading. You see it on the internet a lot, how people turn $500 into $5,000 by trading options. However, what you must understand is that yes, by having the opportunity to make more money, you are also exposing yourself to more risk, and you're exposing yourself to the possibility of losing everything that you're supposed to be investing. Meaning that yes, you can potentially turn $500 into $5,000, but you also have a greater chance of turning your $500 into $5, as the market can go both ways, especially when you're trading a volatile day trading strategy. So for beginners, I would definitely stay away from this altogether, and even more so, I would stay away from this next investment strategy that unfortunately seems to get the most attention out of all of these strategies. And the last investment strategy that you can choose to pursue is called behavioral analysis, or basically you trade in stocks based on what is going on in the media or in the market or any social media platform. This style of investing is what directly led to GameStop having the run that it did, because people on social media were buying it and people saw other people buying it, and it all led to a great influx in demand, which in turn drove the price up, which led people to think that they were actually investors when they were actually gambling on a certain stock. This can also be true with some cryptocurrencies like Dogecoin, because you're not investing on the inherent value of the asset. You are investing based on how much demand the asset has, and once people stop caring about that specific asset, it will drop in value and then cause you to lose money. The scary thing about investing using a behavioral analysis sort of strategy is how quickly tables can turn. One minute you can have everybody loving the stock and the price is going to the moon, while the next day you can have everybody hating it and the price drops right back down to earth. So with this being the most risky of the four strategies I talked about, I would definitely recommend you stick more to index fund investing or even some fundamental investing if you want to be more involved, but I'll try my best to stay away from technical analysis and also behavioral analysis styles of investing. However, once you pick your investment strategy, you can then move on to opening a brokerage account and getting started actually making money. Now, the great thing about brokerage account these days is that almost all of them have zero commissions, meaning that you don't have to pay anything to buy and sell securities. And also, most of them don't have a minimum balance that your account has to have, so most likely you can get started investing with $1. And if you want to know some of the investing accounts that I use Fidelity, but I also use WeBull. And if you use the link in the description below to sign up to WeBull, you can get 2 free stocks for signing up and depositing $5 for a limited time, where usually you would have to deposit $100 to get that same 2 free stocks. I think this offer is lasting until the end of July 2021, so if you're interested in, I would definitely take advantage of that now. So in order to open up a brokerage account, it's basically like opening up any other bank account in the United States. You have to have your full name, some identification, also your social security number, and also if you have any affiliation with any other stock brokerage companies. And also, it's completely free to open. You don't have to have any money to open this account. So if you're interested in investing, you definitely should go ahead and get your account open to get the process rolling, because it can take up to a week sometimes to get your account approved. And at this point, if you've done all these steps, you are now at the point where you can start buying assets and then start making money in the stock market. So what I'm going to do now is actually take you guys into my phone and into my investment portfolio to show you guys exactly what strategy I use and why I use it. And as I pull up my Fidelity portfolio, we can see that I have $52,718 invested with a daily loss of about $95. And if we look at my 3 accounts, I have a taxable account, a Roth IRA, and then a custodial account. But what I want to take a specific look at is my taxable account to show you guys exactly how simple investing can really be. If we look at this account, it has about $42,000 in it. And if we look at my positions, we can see that I only actually own 3 stocks or 3 index funds in this whole portfolio. I own FSKAX, FSRNX, and FTIHX in this portfolio. And those 3 index funds are the Fidelity Total Market Index Fund, the Fidelity Total International Market Index Fund, and a Fidelity Real Estate Market Index Fund. And if we look here, we can see the current values of those positions. And what I think is really interesting is the total gain since I started investing in here, which has been about 2 or 3 months now, and that gain is about $1,300 just from me buying these 3 index funds. So my strategy in that portfolio is to invest based on percentages. I invest on a 63, 27, 10% scale, meaning that 63% of that total account goes into the total domestic stock market index fund, 27% goes into the international market index fund, and 10% goes into the real estate index fund. This keeps everything very simple and allows me to rebalance very easily just in case something goes up too much or comes down too much. And all in all, I think that the best thing that you can do is have a simple investing strategy that does not take a lot of energy, that you can do over a long period of time. With my portfolio, I don't even care to check it every day because I know I have a sound strategy that is low maintenance, that has proven to make money if I stay consistent over a long period of time. And with all that being said, I really hope you found some kind of value in this beginner tutorial to getting started investing in the stock market. If you have any comments, questions, or suggestions based on this video, then leave them in the comments down below, as I do like to read and respond to every single one of them. And I also would like to answer anything that I feel I may have left out, as this is one of my longer videos and I didn't want to make it entirely too long. However, with all that being said, if you did like this video, then go ahead and smash that like button for your boy, as it really does help the channel out. And also hit that subscribe button as well if you feel like you like content like this. But with that being said, I really hope you have a great rest of your day, and I'll see you in the next video, guys. Peace.